In this video, I'm going to show you why you lose 95% of your trades, okay? And if you want to be profitable this year, this video is actually for you. All right, so what are you going to learn in this video? You're going to learn market structure, the in-depth knowledge of market structure. Secondly, you're going to learn when to enter the market, the most accurate way to enter the market, how long you're going to stay, and when you need to leave the market. So we're talking about the risk reward ratio now, and we're going to show you using the real market to exemplify what we're talking about, and then see how you're going to use it in your actual trading, all right, and become profitable. So market structure, what is it? It is the framework or the architecture of the market which shows the direction of price movement, right? And then we said, or we know that market moves upward, downward, and sometimes sideways, all right? So in our last video, we talked about the upward movement of the market. We discussed about how to intertrade, how to analyze it, and all of that. So if you've not watched this video, please make sure you go watch it because we're going to talk about the downward direction of the market now. And this is what this video is all about, and even much more. So make sure that you want to learn so much. So go get the video and watch. All right. So let's talk about the downward direction of the market. So this market right now, theoretically speaking, this is how the bearish, the bearish trend is. All right. So it is characterized by lower lows, all right, and lower highs. Okay. So you get to this, um, you will see the swing low, you will see the swing high, okay, and then the swing low and the swing high, okay, and then that's that. So looking at this, you will understand that when market moved from this, it's had to increase because the bulls have to fight back, all right. But in this market, the bears have much more momentum, all right. So it now moved and broke this particular structure here, breaking the previous low, all right. So let's draw something like this, okay, breaking the previous low. Let's give it this color, right? So that's what happened here, and then it gave you a new low, all right? So a lower low, all right? So now it moved again upward and broke it here, broke it here, all right? So you can imagine and you see that this is the character of a bearish trend. So this is what you need to see to understand that the market is actually bearish, all right? So let's go into the real market to show you how this really, really all works. All right, boom. So now look at this. We're in the Euro US market, the 1 hour time frame. Okay, so what do we need to do now? The first thing you need to do is to look at this market and ask yourself, where is this market going? All right, so it is actually downward at this particular, most likely here. All right, so looking at this now, what you have to do is to first of all draw the line of best fit. Right, draw the line of best fit. So let's use a trend line. Right, so using a trend line, you draw from here. All right, so this thing, this. All right, so I think I'm going to increase this a little bit. I'm going to give it this and then give it a white color. All right, so this now cuts across the swing lows. I think we need to make it something like this. All right. Okay, so that's it. So it cuts across the swing lows. All right. So then what you need to do now is to also go for the swing highs. Yeah. All right. So that's beautiful. So this is the first thing you need to do. you need to draw the line of best fit on the swing lows and on the swing highs. So what actually happened in this market is the tussle or the interplay between the bears and the bulls. All right. So the buyers actually gain momentum at this point, and then because we're on a downward trend, there was a strong momentum, or a fight back by the bulls rather the bears, and then it pushed the price down and then hits, and then there was a reversal. All right, a pullback rather, and then gets to this point and hits, all right, and all of that. So what do you do when you are done with this? Next thing you need to do now, like you draw this, the line of best fit. All right, so 95% of traders make this mistake. They believe that sometimes the market is uniform, right? Sometimes the market is not uniform, all right? So if you are trading and you look at the market and you see that this particular market is not something your head can wrap around, all right, you've drawn the line of best fit across the swing high and the swing lows is not adding up. I think you should not trade that time frame. Maybe you should go to a higher time frame or go a step lower, right? To check to see whether there is a uniformity. If there is not, please look for another security. This is what traders do. Traders believe that they need to trade because they just opened up their computer or enter the market. They believe that the market must be good as soon as they enter, all right? Or the market is actually waiting for them. Market does not do that, right? So you need to do this analysis. And when you are done, the next thing you need to ask yourself, which time frame am I going to trade? Right? Is it the 5 minutes time frame? Is it the 15 minutes time frame? The 1 hour time frame? The H4? Which one am I going to trade? Because all of them have different um, market structure, you know, different dimension, because market structure is multi-dimensional. All right, they have different views, different framework with respect to time. So what are you going to do? The first thing you need to do is not just trading. No, you don't just trade. Look at what you need to do. What you need to do is to, first of all, calculate the average price movement of the market from the swing high to the swing low. All right, so let's get to this. So you need to calculate this in pips. All right, so let's see what happens here. So um looking at this now, this is the 5 minutes time frame. So in the 5 minutes time frame, the distance from the movement from the swing high to the swing low is what you need to know. All right, so how many pips is this? All right, so you are seeing 200 and okay, to 800, right? But it's actually 280 because now the last digit is negligible. Okay, so you have to say 800 divided by 10. All right, so that's it. So you need to record to 800. So the first number is to 800. All right, so you get your calculator to 800, right? Sorry, 280 rather, 280. So you do the next thing here from this, right, to this. Okay, so when you do this, you are seeing 403 plus 403. All right, so you do this again. All right, and then you are seeing 273 plus 273 plus 273. So now you are seeing 956. So this is now the total amount. So what you have to find is the average. So 956 divided by 3, you are getting 318 pips. So this is the average price movement in this, right? 318 pips. So what you now have to do now is let's go to the H1 now. When you get to the H1, we are talking about something different altogether. All right, so you do this average price movement, this here. So you are getting 689, 689. All right, 689. Excuse me. All right, so let's go 689, 689. All right, so that's that. Then you go for something else here. All right, and you're seeing 820 plus 820. All right, and then here, okay, you're seeing 1,256 plus 1,256. All right, so you're getting 2,765. 2,765 divided by 3, and you're having 921 pips. So now this is the average price. Remember that in the 5 minutes time frame, you are seeing a bullish trend, right? So you can see it here from here, right? See the 5 minutes time frame. Then in the 1 hour time frame, you are seeing a bearish trend. So how would you now decide? You have to decide based on the amount of you know your objective in the market. All right, so I wouldn't want to go for 921 pips, or when I cannot trade the 5 minutes time frame, or I wouldn't want to get 921 pips in the 5 minutes time frame. No, because right now the big mistake that traders do is that they make unrealistic expectations. You don't give the market what you want to gain from it. Rather, the market will give you options and you choose from the options. So traders make this big mistake. All right. So someone can give himself or herself a target of 400 pips, and you just go into the market believing that it has to be 400 pips. Oh, the market must get to this level. No, you have to be objective in your approach. Just like when you want to go for an exam, you don't know the questions. Rather, you have to read and then go into the exam, and you have to read questions that are likely to come out, and then from there, with the knowledge you have, you can from the options of in the exams, get your papers, and all of those things. So that's how it works. All right, you go to a store, you want to get a shoe. You don't just say, oh, I'm going to get a shoe of $2. No, you go into the market, then you go to the shop, see what the shoes or the price they are offering for a shoe, a pair of shoe, and all of that. Then from there you can negotiate. So that is what the traders do. They just say, oh, I'm going to get maybe 10,000 pips. The market may not have that. It may not be attainable. So you have to look at it. So this calculation is really important, right? Very, very important. With this calculation, it will first of all show you which particular time frame you're going to trade, and your risk to reward ratio. And one other thing I want to also talk about is patience. All right, you need to be patient for this, for because after drawing the line of best fit and all of those things from the swing high to the swing low, you need to wait for it to move from the from up to down and down to up. You need to wait for it. All right. So with this calculation, because everybody have different, waiting tolerance, or weight tolerance rather, or patience. And patience actually, I would say now, differentiates the pro from the naive, right? So what you need to do is to check your patience level. Many people can't wait, but if you can wait, trust me, you will be trading, let's say, the H1, because right now, your waiting patience gives you what will I say now, categorizes you whether you're a day trader, a swing trader, and all of those things. So now you need to choose, right? And then when you are choosing the 5 minutes time frame, you know the particular risk, the reward available. From there, you calculate your stop loss now. From there, so now if I have 318, all right, 318 for the 5 minutes time frame. What I need to do is, let's go back to the 5 minutes time frame now. I hope, okay. What I need to do now, because I need to be very realistic and then be rational, I would say that my reward will be half of that. I will give it half. I will be like 318 multiplied by 0.5. That's half of it. That will be the reward because this is giving you a surety that the market will definitely get to this. If you want to go for maybe a high reward, I think you should go for two thirds. So the two thirds, 2/3 of this, of the average price movement would be 0.66. So you'll be saying 0.66 multiplied by 318, right? So this will be your reward because in this you are trying to make most accurate trades. You are not trying to be like okay and all of that. So, but if you want to go for the bigger one, right, you need to go for H1, and you need to align yourself with what the market is saying. You don't decide. No, you have to be objective, not subjective. No, the market won't listen to you. All right. So these are the careful things you need to do and see trading as a business. If not, going into trading without sufficient knowledge like this makes you a gambler. In fact, I would say gambling is going into anything in at all, any venture without sufficient knowledge. I would say appreciable knowledge. Appreciable knowledge. So there is a minimum or sufficient amount or appreciable amount of knowledge you need to attain for you to go into something so you can make informed decisions. All right. So this calculation right now will give you what to do. So if I would want to, okay, say that I'm going for, okay, 318 now. So I want to go for a very strong, a high, profit. I will use multiply by 0.66. So 0.66 will give me 209. So that is a 209. So all I have to do is go to this. All right, then 209. I'll just do this. All right. 209. So now, so what would be my stop, my risk now? It should be half of it. All right. For those that are doing 3:1, so you can actually say if it's 3:1, you have to now divide also by 1/3. So, 1/3 will give you 0.33. So now 0.33 multiplied by 209. So it will be giving you 68 pips. All right. So let's round it up to 69. All right. So now stop loss now is 69. All right. So that's that. So all you now have to do is to, you know, get to this place. So as the case may be, looking at this chart is most likely to go, down bearish now. So all you have to do now when you are done is to just place a sell, right? So now you see that the sell, has been placed. The sell order has been placed here, right? So that's that. So as simple as that, you now see that it's actually quite much easier. So if you want to get this software, check the link below on our website so you can get this software. So it can give you a better way of making your work easy or giving you more accurate, entry. All right. So that's that. And then the next thing you need to do, like I just mentioned, is you need to be patient. All right. So if you are patient in this, if you're patient, you will have to allow it to get down. All right. So now when it moves to this level from this swing high to this swing low, the next thing you need to do is you wait for a confirmation. You wait for your confirmation. So what will be your confirmation? what will be your confirmation? So what will be your confirmation? All right. So your confirmation is the swing. You are looking for a liquidity sweep. Now, in this case, you are looking for a bullish liquidity sweep. So what is a liquidity sweep now? Liquidity sweep now is more like price in the opposite direction with a strong momentum, right? So you're looking for a bullish candle with a strong momentum, you know, sweeping or clearing out the initial movement in the opposite direction. That is what a liquidity sweep is, right? So now look at this. It moved, and then you see this candle stick here, very strong here. So you can now say, all right, I'm going to trade this. One thing you also need to do as a trader is you need to also, like I said, be vigilant. Okay, so you can now place a trade here, right? You can say, I'm going for a buy. All right, I'm going for a buy after this. All right. So, but okay. So looking at this now, with what you have done, remember your calculation, all right, and all of those things. You can place your trade here, and right. So, but looking at this now, you see that um you were hit here, right? Hit here. So you can place another trade here. All right. Now, when it comes to this, we are talking about going short now. All right. So you hit it like this. So you see on the liquidity. All right. So now you're seeing after the liquidity sweep, the bearish liquidity sweep, we place the trade. There are some traders that will have to wait for a retracement. So it's your choice. The main thing is your choice, right? But you can imagine after doing this calculation, you will now see that you gain here, you lost here. So now if you're doing 3:1, you can imagine that you are still in profit. All right. So then you repeat this here again. You repeat this here again, right? So you are also profiting here as well. All right. So, and then let's just add this together. This also. All right. So you see, after this liquidity sweep here, okay. So you see, you may wait for a retracement. That's cool. But the thing now is that you are working with high level probable statistics. Now you are working with high level probable statistics. So now you see that you won here. All right. You profited here. You profited here. Okay. You also you lost here now. You profit. All right. You lost. You profit and you profit. So you are good. So that you lost is not the end of the story. It's about you having the right tools. All right. So, like I talked about waiting, this is one of the biggest problem of traders. So sometimes a trader may just go into the market. Sometimes he feels that maybe when he enters the market, waiting may be like um, I'm not doing anything. No, you should just have to wait according to this analysis. And then I would say that you can just go to this. All right, so all right, so now assuming that okay, assuming let's do something now. Assuming that this is where you need to wait. All right, so we hit here. All right, so you ought to wait here. Okay, you ought to wait. It is an assumption, right? So you are seeing 3363. That's 3363.27. So that's that. So all you have to do is, all right, go here. Okay, so let's just use the other market. So 336.37. All right, so you just get to this place. All right, and then all you have to do is okay, now we are talking about a low now. So you wanted to get to this price. All right, so you have to now say 3363.27, right? So I think this is very, very much useful, especially if you're working. So it will send an alert to you, a mobile alert to you, and all of those things. So this tool is actually useful if you need it. Maybe you have a tight schedule, all right, and all of those things. So when you are done with your analysis, you can now impute, the value and go about your business, and then it gives you an alert. Then afterwards, you now wait for that confirmation and you place your trade. Awesome and awesome. All right. So if you want this tool, like I said, this is available on our website. All right. So go check it. So now the next thing now is to recap. So what have we talked about? We've talked about many, many things. And we talked about the market structure, what it's all about, and the things you need to do. The first thing is to draw your line of best fit. The second thing you need to do is to calculate the average price movement. With this, you can now determine the time frame based on your weight tolerance, or how much you can wait, or your patience, the time frame, whether it's a H1 or the 5 minutes time frame. You can also from there decide or determine your excuse me. You can also determine your reward and risk, your risk to reward ratio. A well calculated, an informed decision can be made with this. All right. And so that's that. All right. So another thing, you have to be good with math, right? So you have to be good with your math. So please, just basic math, plus, minus, division, multiplication, and all of that. All right. So if you learned anything um, in this video, please like and subscribe. I tell you, if you're able to, analyze the market across time frames, make calculations, and all of those things, you have the key to the market. This video, if this is the only video you know to watch, I tell you, this cuts across all markets. And another thing you need to know is that you also have the key to build a sophisticated, profitable machine learning algorithm, right? You can do this. Write codes, programs that suit your, trading preference. You can actually do that. For those that want to learn more on this, you can check our website and then you learn. All right. So I believe that the day you stop learning is the day you start failing. So learning never ends. Okay. So that's that. In our next video, we're going to talk about why traders lose trade and how to beat the big institutions. So that's what we're going to talk about. Why traders lose trade and how to beat the big institutions, especially when you have, if you want to get the sniper trades, you want to, trade on a rally and all of those things. We're going to discuss it in the next video. All right. So make sure you watch this video over and over again if you don't understand it, so you can be very much profitable this year. All right. So bye for now.